you. Otherwise, you can just put it in our Q&A and we can answer it that way. Stay till the end. We have free creatives that we are willing to send you, their digital version. We'd be happy to co-market with any of the realtors that are on this call today. So, did I miss anything?
I don't think so.
All good, Karen.
Don't, if you're a NEXA LO, don't make me be mean to you.
We want to keep Dan in nice mode today.
There you go.
Beast mode activated.
There you go.
Awesome.
Well,
Nancy. Oh, go ahead, Dan. You can introduce.
I was just going to say with that, Nancy, take it away.
Okay. Well, good morning, everyone. Thank you for taking your time to come and learn about commercial real estate loans. I have an extensive background in that market, so I'd like to share with you some of my knowledge. Most of you, I might assume, and of course I did take a survey, come from the residential market. And I just want you to know that to qualify someone to buy a building is a lot different than to qualify someone to buy a home. So first off, you wouldn't ask them to fill out a loan application because the commercial lenders don't care. Second off, what you need to understand is that when you're going to buy a building, there's two types of loans you're going to look at. One is to buy an investment building. So if you have a client that wants to expand their real estate portfolio into commercial and buy an investment building, that's going to be based on the cash flow of the building. If you have a buyer that wants to occupy a building because he operates a small business, then you're going to look at an SBA loan. And both of those loans are different. So we're going to start with the commercial loans. The commercial real estate is determined by the cash flow of the building. And what every lender won't do every kind of loan because there's different kind of projects. So you might have a retail building, you might have, a small strip center, say it's got 5 tenants in it, or you might have a small medical building, you might have an office building, you might have an industrial building. Whatever your building is, first off, you got to make sure that the lender would want to even finance that. So what you need to do to see if a lender is going to finance that building is you need to take pictures of the building inside and out. They want to see the area. They want to see what kind of improvements are done in the building. If you can't get into every suite or every tenant, you need to give them a couple samples. You need to give them a street address, because what the lender is going to do is, first off, they're going to look at the street address and tell you if they even care. If they care, then they're going to ask for the rent roll. The rent roll is comprised of all the tenants in the building, and it determines the cash flow of the building. What a lender is going to look for is they're going to look for the term of the lease. Most lenders want to see at least 3 years of existing tenant occupancy on that current lease, if not 5. And then they'll look to see if there's some extensions to that lease or options to extend the lease. And they're going to see if they're adjusted to market rent. There are 2 types of leases that are done in commercial real estate. One is called a gross lease. A gross lease includes all the operating expenses of a building, which is rolled into the rent. The other is a net lease, and you'll find in today's market, I would say probably 80% of the market is a net lease. What a net lease is that the tenant is charged a monthly base rent by the landlord according to what the local market will bear, and then they'll add on the operating expenses of the building, which will be taxes, maintenance, security if it's a high-rise building, and insurance, and they will do an aggregate account of 1 year, and then they will divide it by the occupants of the building, and you will pay your, you will pay your proportionate share of those operating expenses. Landlords and lenders prefer the net operating leases because that income is stable for the investor or stable for the lender, and the tenants will pick up any increase of operating expenses. What you find in some leases is that the landlords will cap any inflationary amount to operating expenses because in the end, they don't want to lose their tenant. So they might put a cap on the initial adjustment to their base rent, and that will be adjusted throughout the lease. Once the landlord will want to demand to see or the lender is going to want to see the rent roll, they're going to want to make sure that the operating income is going to be able to cover the debt service of the building. And the debt service of the building would be the same as a home. You know, it's going to have principal, interest, taxes, and insurance. So that's called, in the commercial world, the net operating income. When you take away when you add up all the income and you take away the expenses, that net operating income is going to be available to service the debt. If you have that coverage, you're very likely going to be able to get a loan on that building. And in those instances, what you're going to find is that you're going to need 30% down and 70% loan to value, basically. Then they are going to want to see one of the purchasers' FICO score to make sure they're credit worthy. Most people investing in commercial real estate set up some kind of operating entity, whether it's an LLC or S Corp. In that instances, the lender will hold that liability, the partners, if they're operating member of the LLC, they'll hold that partner liable for the debt so that you cannot default on the loan behind an operating entity. So you would need all the documents for that LLC. And then you would need to provide, if you want to buy the building, the seller is going to have to provide 2 years of operating income or taxes to show that the building operates at a positive cash flow to service the debt. So if you're trying to list that building, make sure you're able to get that information from the seller. If the seller won't provide it to you, then you aren't going to be able to sell the building unless you bring in a cash buyer. So that would be on investments. If you have a small business owner who wants to buy a building, that would be called an SBA loan. SBA stands for Small Business Administration. The mandate of the Small Business Administration is to help small business owners grow their business. And that they've created guidelines for financing small businesses. There's 2 types of loans that you can get from the SBA. One is the real estate, so that the small business owner can buy the building they're in. In that instances, they will do a 90% loan to value with 10% down. Typically, those loans go up to $5 million on the SBA. Once you get over $1.5 million on a loan purchase, or up to $2 million, basically, depending on the community bank, you're going to do what's called a 504 loan, which is a split loan. It's between what the bank will lend the $2 million and the $3 million will be sold. It's a bond, and they'll price it whatever the local bond market pricing is at the time. That's called a 504 SBA loan, and that's for your higher priced buildings. If you're going to, if a business owner wants to sell their business along with the building, because you might get a lot of requests for that, that business opportunity is financed separately, although it can be financed within the same loan. But on the business opportunity side, this buyer is going to have to put 25% down of the business opportunity. And if they're coming in to buy it, they are going to actually have to have experience and operating some kind of business. If they don't have that particular business experience, then what the lender is going to require is that either the seller signs a contract to stay on as a consultant or a manager, or a key manager stays on for and signs a contract that the bank can see for at least 2 years, so that the bank is assured that that business will continue to operate profitably. In the SBA loans, they will finance. They have what's called a SIC code. You have and then it's also capped by the annual income that a business makes. So what you have to do is you have to look up the SIC code and see that that business can be financed by the SBA. And then you got to see what the maximum loan annual income they will be able to make in order to qualify. I've had a lot of businesses that try to buy SBA through an SBA loan, and they've just made too much income and they can't qualify. So they need to go out and get a business loan, which is going to require them to put more money down. When you get an SBA loan, the SBA will look at the loan guidelines require that whoever owns 25% more of the business has to put up their tax returns, last 2 years tax returns, and their FICO score. So that would be kind of along the same lines of qualifying for a home loan. They have to show that they're credit worthy and they have assets. If the business opportunity loan is wrapped with the real estate loan and the lender feels there's not enough equity in the building, then what the lender's going to do is they're going to wrap and lien the primary operators of the business that own 25% or more. They're going to lien their homes and they're going to subordinate to the first debt. But, you know, so you need to be really clear when you explain this to your borrowers because, you know, I've had buyers come back, you know, they bought the building and they got a lien on their second home and, you know, now they got $1 million in equity in their home and they want to refinance it for other purposes. And they'll call me up and say, well, the SBA lender won't subordinate to a new loan. I was like, no, they won't because they don't have to. The guidelines say they can or cannot, but we all know that lenders have their own overlays. So in that instance, the most of the lenders will let the buyer or of the building, they'll let them refinance their primary residence if it's a rate and term reduction that's beneficial to the business owner. But to pull out more equity and increase the loan size and put the SB lender at higher risk, they won't let them do that. And I just had a client that I told them I couldn't help them because they wanted to refinance their home.
Oh my goodness. Okay. And that's a normal practice where they use their home, they use their property as almost like collateral?
Well, Karen, that would only be like if you're doing the business opportunity plus the real estate. Because if the real
Okay.
estate, yeah, if the appraised value of the real estate has enough value, then the lender's okay with that, right?
Yeah.
But if they get the business opportunity or they're concerned about their ability to operate the business, then they might wrap the loan and they might wrap their homes. And that's something the borrower has to determine if they want to do that. Now, as all loans, there are SBA guidelines and then there's lender overlays, and not every lender will do that.
Sure.
Your best bet on getting an SBA loan is to go to your local community bank because they're mandated by the FDIC to put money back in the community. The local community banks love SBA loans because they're guaranteed by the government that if there's a default, they'll get 75% of that loan returned. So this allows them with their depository assets, because if you own a small community bank, you have to make the assets work in order to be profitable. So by as soon as they fund an SBA loan, they can go out and sell it on the market, right? Or they can service it, but then they can keep turning their assets and keep funding these SBA loans. And if you are going to go to community bank, you just want to make sure they're a preferred lender. A preferred lender has been authorized by the SBA to underwrite to the guidelines of the SBA. And so then your loan package does not need to go to the SBA. And I think it's a disservice to the community that they think this is so hideous and it takes so much time. I sold SBA loans for 6 years. I could fund a loan in 30 days if I could get the business owners to fill out the loan package. Because as well, well, you know, there's problems everywhere, right? So the SBA, and you know, once a business owner has gone through it, they really sometimes don't want to do it again because it's like, oh my God, I got to do all my personal and then I got to do all the business income. So, and you need it from every owner. And sometimes you have partners that don't want to do it. So it creates issues within the own company. But it is a great way to segue and being able to own your own building. And what the SBA lender will do is they don't look at the operating costs of the building. What they do is if they take out the existing rent for the operation of the business where they're leasing, and they put in the cost to own the building, does the business still cash flow?
Gotcha. So now when our realtors are speaking with somebody, let's say somebody walks into one of our realtors that are in the room today and they're like, I want to buy this building. What are the first what is the basic pieces that they need to know if this is going to be, if they're going to be spending their time fruitfully, or if this is just going to be like kind of a rat race? Like, what are some key pieces? Excuse me.
Well, if you're talking about investment property, there's no pre-loan approval, okay? So that doesn't exist. If you're going to list the property to sell and you want an investor to come in and have a pre-approval, that just doesn't exist because, you know, they're
Gotcha.
commercial loans. They're like a non-QM loan. So there's no standards they have to fall under. Because the
Mhm.
market you're talking about, that's, you know, walking around looking at the smaller buildings, you know, they're under $5 million, right? So you're into private money and hedge fund money. So they can create whatever rules they like and whatever the market will bear, and that's how they're going to lend their money. A lot of these loans also will have 3 to 5 year prepayment penalties. And at that time, you know, you can buy down the prepayment penalties if you like, but usually they'll charge a 0.5 point a year on the
Yeah.
value of the loan to be able to buy it down. If you're a small business owner, then you just have to make sure that the year you want to buy the building or the last 2 years, because the SBA guidelines require 2 years of business tax returns. You want to make sure that those 2 years of tax returns are profitable, because if
Right.
they're not, you won't get a loan. So I've helped business owners restructure their taxes because I would tell the CEO, well, you're going to pay one way in life. You're either going to pay the IRS or you're going to pay by not being able to get credit. And I don't care which. I'm not judging you. Just pick what you'd like to
Right.
do. Yeah.
Yeah, that is very true. So, okay, so this is not something that you just decide one day and jump into it. This is definitely something that the borrower needs to prepare for before they come to our realtor partners and say, this is what I want to do. Now, for people who have not had, and I know you touched on this quick, but for those people who have not, they have not gained that experience in investing in these type of properties, what would you suggest our realtors tell them? Like, what can they do to get to that point where they are ready?
And would that be an investor or owner user? Because they're two different buyers.
Let's say owner user.
Well, owner user, you know, if they've have a successful business and they've watched their rent increase over the years, they want to buy a building to stop the bleeding from the
Okay.
increase in rent. So they typically, because they're involved in, you know, the business community and with their bank, most of them are typically aware that they can get a SBA loan and they want to buy their building. So, and the SBA loans will also, they're great for construction loans, right? Because they'll do a
Oh, okay.
10% down, 90% financing, and that, you know,
Yeah.
I guess if you're trying to compare it to the residential market, it would be like a one-time close loan because they do the construction and it includes the takeout loan on it. So, and they'll do it at a 90% loan to value, which is just remarkable. Um, and that's helped a lot of business owners. I've helped a lot of business owners that way.
And what kind of credit are they looking for on those owner operator loans?
Well, you know, they're going to want, I mean, you know, you need 640, 680 and above because they want to
Okay.
know that you're viable and you pay your bills, right? And
Sure.
again, it's about how are you managing your debt, right? And they don't really do a DTI, they do a cash flow analysis, right? So I guess it could
Right.
be compared the same thing, but there's no back end or front end DTI. It's we look at your income. If I put in the cost of the building, do you still cash flow? Can you pay yourself? Can you pay your employees? Can you pay your taxes? Can you operate your business and still buy this building? That's what I would look at. So I've done a lot of cash flow analysis on a lot of business. I would tell you that in America, if you can own a little widget company, you're a multimillionaire in 5 years.
Oh
Like the
my
guys,
goodness.
I mean, the guys that made, I kind like corrugated boxes, okay?
Yeah.
Like you're making boxes that people buy. Oh my God. I mean, they can net $5 million a year cash flow out the door because their cost to build those boxes is so small and their profit
Yeah.
is so big. It's just amazing. Or the people that build screws. I mean, I just found it was really an interesting time in my career when I did the SBA loans to understand what kind of business were profitable. And even restaurants, you know, typically lenders don't like restaurants. There's two businesses they don't really like, restaurants and gyms, because they have the highest failure rate across America. So, but if you're profitable as a restaurant, I mean, they make some serious bank. I mean,
Sure.
if you know what you're doing. So, but be aware of that. If you got a buyer that wants to buy a restaurant or with a building, you know, that's going to be a hard sell unless they have
It's gonna be
experience
under
and it
scrutiny.
shows
Yeah,
profit.
that makes sense.
Yeah.
Let's see. So does anyone have, I don't see any questions so far. Does anybody have any questions for Nancy? A lot of information so far.
Lot of
is-
information, yeah.
Lot of information. That's, and you know,
I
that's
think we recorded this.
right. And that's one of the benefits though of having loan officer support, because if you do have these questions, you can log on with your buyer and we can Zoom all together and ask those pertinent questions. So you know, I mean, nobody wants to work for free. Let's be honest. Ask the questions in the front on the front end. And this way your process goes much easier. How does Next Loan Officer partner to offer SBA loans? How does a NEXA loan officer partner to offer SBA loans? Not sure I understand that question, Brandy.
Well, I think they're asking if, yes, we have a relationship with SBA banks, if that's what you're asking.
Oh, okay. I'm
Yeah,
glad you
so-
understood. Because I was like,
Right. I mean, so if they want to get SBA loan, I would ask for 2 years of personal tax. I would see who's the operator of the business. I'd ask them how long they've been in business. I'd ask them what's their annual income. I'd look up the SIC codes and make sure that their income qualifies and the business qualifies. And then I want to then I'd want to see their taxes. 2 years of business taxes and 2 years of personal taxes. I'd run a credit score, I'd cash flow the debt, and then I'd tell them what they could qualify for.
Gotcha.
And get financed. And again, they can get financed. I mean, I financed, you know, $2 million buildings in 30 days or less because I had business owners that actually wanted to perform. And, you know, then it can take, you know, 60 days, right? If they move
Yeah.
slowly or, right?
Yeah, so
But-
it's really dependent on all parties involved. Let's see here. Do we do SBA commercial land loans?
No, the SBA will not lend on land loans. And the reason you find land loans really hard to lend on is because a bank will look back at the property that they're going to lien and they'll say, okay, if this borrower defaults, what am I going to do with this land?
Gotcha.
Nothing. So they don't do that. No. If you want, the SBA will finance a land with the building plans. So if the business owner wants to buy a piece of land and they'd like to build a building on it, then yes, they'll finance it all the way through and all that borrower has to put down is 10%. But they won't, you know, I've had people come in and they wanted to, you know, a lot for their storage for trucks or whatever, their
Yep.
products. No, they're not going to finance land on its own. They have
Gotcha.
to put a building up of some sort. And then,
Perfect.
so if you want on the SBA, just remember, if a borrower, a business owner gets a building bigger than what he'll occupy for his business, it's mandated on the SBA guidelines that that business owner has to occupy 51% of that building. But he can, they can lease out the other 49%, but that's the occupancy rule to get
Okay.
SBA loan.
That's good to know too. Let's see here. Betty is asking, can you please repeat the requirement for the building operating income?
So,
you
so
mean-
Betty is one of our next LOs and it's gonna make me be mean to her.
Betty, no.
Betty, jump into LO support and you can get the answers to that question. Or you
Absolutely.
can review the recording of this. I think it's being live streamed on Facebook internal page as well.
External page,
I'm sorry, Facebook. Why? I don't
public
know.
page for everyone.
It's being yeah.
And Betty, that was actually really nice. So Dan's in a great mood today. I can already tell. Herb, we have a question from him saying, can we finance a group home with an SBA?
Herb is also a NEXA LO. And
Holy
should be
smoke.
logging into LO support to get his answer, or should have attended last week's presentation where he could have gotten the answers to this question.
All
But
right. How
I'm
about
actually
Bruce?
gonna let Nancy answer this one because I think it's a very good question.
Okay, cool.
What's the question?
Can we finance a group home with an SBA?
Can you do
Sorry,
what?
I
I'm
was
sorry.
laughing through the whole time of that. Can we finance a group home with an SBA?
Well, there's all kinds of group home. What kind of group home is it?
Now we're getting in the weeds.
Now we're getting in the weeds. So here's the deal about group homes, okay? There's no guidelines that say you can't, right? But again, it comes back to the lender, the bank, right? And they put their own overlays. So the smaller community banks, okay, I could not finance group homes or, like senior care homes, because as it was explained when I brought my first loan package there to the president and asked him why he wasn't going to consider my group home, he said, do you understand the PR? I said, well, of course I understand PR. He said, well, if this person defaults, right? Do you understand the PR nightmare if I got to go and foreclose on that loan and I got to wheel out all these old
Oh
people out of
gosh,
the
yeah, I
home?
never thought about that.
Yeah, so there are specific lenders in the market who do lend on that niche, but I think you'll find most banks do not want to do group homes because they have a lot of issues with the American Disability Act and the PR issues of kicking people out if the buyer defaults on the loan, the borrower defaults. So
Right, so your liabilities are a whole new ballgame in a group home.
right, you're involving people.
Yeah, absolutely.
Kind of falls in the same
Alright.
line as like churches, right? It's difficult to finance a church because who wants to foreclose on a church?
Well,
Right.
the problem with the churches is their operating structure, Dan, basically, because most churches are structured as a nonprofit organization. And they're based on the assets of from the members, the church members that come and their offerings, right? So in order to finance churches, again, there's a niche companies that will finance churches, but what they're going to do is they're going to mandate that the elders of the church, however you want to view that, because there's always a select group of people that operate the church,
Sure.
sign on the loan, and they're going to put up their financial statements, and that's how you'll get a church financed. But most
Wow.
lenders won't do that.
Right. And it's 10:28 and we have one more question. So we'll address this. And then I think we will wrap it up. Is the down payment typically 20 to 25%? And that you did mention that, Nancy. So on on the investment side of it, it's 30%, correct?
Right. It's 30% in today's market. Because with everybody, a lot of people going back, to remote working, and there's a lot of vacancy. So there's a lot of unsettlement in the commercial lending market right now. So no, they want 30%. They want you fully vested in that building. So it's typical. It's very, very hard to get. You won't find 20% on commercial buildings unless you're going to pay hard money at astronomical rates that it won't make sense. So 30%.
Right. Okay, Bruce was just mentioning this because he has a client that wants to purchase a building in Texas to refurbish and start a feed store. And so he says the full 20 will eat into his refurbished budget. Any ideas? And you just heard from Nancy that it's probably going to be a hard stop if he doesn't have at least that 30%.
Well, if he's going to operate a business and does he have an existing business? Then you can go the SBA route and, build the building,
Oh, there
right?
you go.
But he has to show cash from a business. But a startup, some lenders will do it. It's a real tough sell because you don't have any income to support the debt. So he's going to have to
Right.
have income and show a business plan. And the best thing to do, the SBA regional offices are located in all major cities across America. They have a wealth of information to share. They have a lot of seminars they give. They give a lot of counseling free to business owners. So if the business owner really wants to get an SBA loan, it would behoove them to either call or go into their local center and take advantage of the wealth of information that they're willing to give you. And then they'll give you the list of banks that might be more applicable to the type of loan you'd like to do for your borrower.
All right. And with that, it is 10:30. So I would like to thank everybody for being here. Nancy, as I said, wow, you blow me away with all the knowledge. I really appreciate that. Mia, thanks for getting everything together. You're always so on top of things. And Dan, I'm so glad you're in a great mood today.
You know, it's always that I have enough coffee. When I don't have enough coffee, I get grouchy. So,
Same.
Mia, what's on topic for next week?
So we'll be having FHA loans with Christina Sides next week.
Awesome.
Wonderful.
Nancy, thank you so much. I know your time is valuable. Appreciate all of your knowledge and your willingness to share it as always. So
Oh, you're very kind, Dan. You know, I think it's important to help people and let them know there's just a wealth of loans available, and any information that I can share, I'd be happy to. So I feel honored and humbled to be here and be able to come. Thank you for
Well,
inviting
thank
me.
and,
Thanks so much.
you know, and for the realtors, this is really, you know, anything additional we can put in your toolbox, right? To help you,
Absolutely.
you know, close another deal, bring another client to your portfolio, and hopefully bring another client to your next LO, right? So everybody have a great week, and we will see you next week. Just, just, just for Karen, same bat time, same bat channel.
Love it. Thanks,
Have a
guys.
good week.